Okay, here we go. So in the past, we've done a few webinars. What is an option and why do you care? Why should you use options? Those are also to be found on the Ava Options playlist on the AvaTrade YouTube channel. But today I wanted to go into a little more detail about a specific calculation or a specific measure of an option called delta, because delta is a concept you're going to hear about a lot. It's an important calculation. It's an important description of an option's characteristics, and it's quite intuitive once you understand what it is. So let's go ahead and have a look at this presentation. So here's my first slide, profit and loss. Remember, we're going to talk about options. This is a picture of the profit and loss of just buying Eurodollar FX, not buying an option, just FX. On the x-axis, we show the market going up and down. And on the y-axis, we have your profit and loss. And very simply, if the market goes up, let me get a pen up here. If the market goes up, you're going to have profits. If the market goes down, you're going to have losses. That's what a CFD or FX trade is. It's simply symmetric exposure, up or down. Buy or sell, that's all you can do, and you can limit your risk using stop losses and take profit. Let's look at options. Here I've added a call option. A call option is a product that gives you the right, but not the obligation, to buy an asset in the future at its strike price. So it's asymmetric exposure. In this example of a call option gives you the right to buy at the strike price, but not the obligations. That means as the market goes up, you can have unlimited profit potential. If the market goes down and goes against you, if the market finishes below the strike, you walk away. You don't have an obligation to buy Eurodollar at the strike, which means the most you can lose is what you paid for this option. What you paid for the option is called the premium. So you can see it very clearly in this diagram. The premium is showing us our maximum loss potential. But on the upside, you have unlimited profit potential. It does underperform trading the underlying because you have paid that option premium. So that's the balance of buying protection on the downside versus giving up a little bit of upside. You're paying for protection. This is often compared to insurance and other measures of protection that you might buy. Putting some numbers on it, this is an example of a 1-week call option on Eurodollar. This was done a few weeks ago. So we said if the market is trading at 115, put in my highlighter, the market's trading at 115 right now, and you buy an option with a strike at 115. If the market goes up, you'll make profits above 115 and above recovering your premium. So if I've paid 0.006 or 60 pips premium for my option, then once the market is higher than 115.60, I'll start to make profits. That's my break even. But I'm participating in the market going up from my strike level, and I don't participate in any further losses below my strike. That's what an option looks like on the expiration date. That's the profit and loss of an option on the expiration date. Today, when we're buying the option, the premium is 0.006. Today, we're sitting right here in the center. I buy this option, I pay 60 pips, it's worth 60 pips minus a small bid-ask spread. So let me put on my pen. We're sitting right here today. As the market moves higher, I'm going to participate. If the market finishes lower, I'm not going to lose any more than the premium I paid. So let's say we finish at expiration, the market's much higher, and we finish right up here at 118 or something. If that happens, my profit is going to be 118, where the option is finishing, minus the strike, which is 115. That's 0.03 or 300 pips, minus what I paid for the option, the 60 pips. So my profit is 240 pips. If the market finishes all the way down at 113, let's say, or anywhere below the strike, I'm going to lose my full 60 pips. Today, we know we're sitting here. So how do we get from today's price of 60 pips to our endpoints at expiration of reaching the expiration payoff line. Here's a picture. Today, we said the option costs 60 pips. It's worth 60 pips. We're sitting right here in the middle. As the market moves higher and higher, we approach the expiration payoff line. We approach the expiration payoff where our participation is 1-for-1. That means that once we're deep in the money and there's no optionality left, the probability of falling back below the strike is very low. My delta is going to be close to 1. So what is delta? Delta is the change in the option price relative to the change in the underlying. When we get up to the extremes, when we're deep in the money, as the market goes from 118 to 118.10, spots going up by 10 pips, the option will also go up by 10 pips. Its delta is 1. On the expiration date, its delta is 1. Just before the expiration date, or even today, its delta is going to be approaching 1. And down on the other side, when the market's out of the money, if we're trading way down here at 112 or something, the option is way out of the money, it's going to lose all of its value. And once it hits 0, it can't be worth any less than 0 because it's just a contract that you own. It's a right that you own. So the minimum value is 0. And as we're approaching expiration and as the market is out of the money, it'll approach 0. And no matter at 113 or 112, if euro dollar goes up or down 10 pips, the option is still going to be worth 0. So there our delta is 0. So out of the money call, the delta is going to be close to 0. A deep in the money call, the delta will be close to 1. What's the delta today when we're at the money? At the money meaning the strike equals the current price of the underlying or the forward price of the underlying. There the delta is about 50%. If the spot goes up by 10 pips, we expect the option value to go up by 5 pips. If spot goes down by 10 pips, we expect the option to go down by 5 pips. So the sensitivity of the option price relative to the underlying is 50%. And as time goes by, this orange line, which is showing us the value of the option or the profit and loss of the option today, it's going to drift down and it's going to approach the black line, which is the expiration value. And I'm going to show that to you when I open up the app and show you an exact example. So the delta today is around 50% at the money. As the market goes higher on a call, the delta goes higher. And as the market goes lower, the delta goes lower. What about a put option? A put option gives you the right to sell at the strike price. It's similar to going short. You're going to profit when the market goes down. What does a put option's delta look like? Well, here's the orange line. Today we're at the money. Whatever we paid for the option, that's its current value. If the market goes much higher, the delta will approach 0. It's out of the money. And if the market goes much lower, the delta will be approaching -1. Because down here, if spot goes up 10 pips, the option is going to lose value of 10 pips because we're short the market, not long. So put options always have a negative delta, and call options always have a positive delta. Remember, call, you're going long the market, put, you're going short the market. What's the delta of FX, of just trading the underlying or trading a CFD? If you buy a CFD or if you buy FX, your delta is 1. If you go short, your delta is -1. Let's look at selling a call option. And if you don't know what a call option is, please stay with me, and you'll understand more as the presentation goes on. If I sell a call option, I'm essentially going short the market because as the market goes higher, I'm exposed to unlimited potential losses. So if I'm short a call, that means that somebody else is able to buy away from me the security. So somebody can take my euros away from me at the strike price, so I have unlimited potential losses. As the market goes higher, my delta approaches -1. As the market goes lower, the option becomes worthless, and my delta will become close to 0. Today, -50%. Here's selling a put option. Selling a put option is analogous to going long the market, or potentially going long the market, because if the market falls, whoever bought that option from me has the right to put to me, to sell to me, the underlying asset at the strike price. So if I'm short a put, my delta is long 50% at the money, generally speaking. It's going to approach 0 as the option moves out of the money when the market's higher. And my delta is going to be close to +1 when we're deep in the money, because my profit and loss for every pip in the underlying market is going to be matched 1 for 1 by the put. In particular, of course, at expiration, there are only 2 possibilities for the delta. It's either 0 when we're out of the money or 1 when we're in the money. Now let's try to understand more information from this delta. What is it really telling us when a delta is 0.1? It's telling us that the option is out of the money, but what else can we deduce? What else can we understand from that number? Well, let's start by saying the at the money option today, if we buy an option that has a strike price equal to the current market level, the market will finish higher or lower. It's a 50-50 chance. Either it's going to go up, or we're going to go down, or we'll stay right here. But at the money, you've got a 50% delta, which is really telling us we have a 50% probability that this option is going to finish in the money. Let's look at it another way. This is what I often use to teach about option value and to conceptualize the value of an option. This lattice of that you see, these gray dots, imagine that those are nails on a board, and you have a board on the wall, or it's just nails on the wall. And if you may have been to Japan, or if you've played pachinko, or think of it like a pinball machine, as balls, we put 1,000 balls up here at the top of this lattice in this funnel. We put 1,000 balls and we drop them down through these nails. The nails, actually, there's a name for it. It's called a quincunx. Someday I'll learn how to say that properly. I think that's right. This was a method created by Sir Francis Galton, I think in the 1800s, to describe or to demonstrate the central limit theorem, which really is all about probabilities, which you're going to see in a moment. So I'm going to drop 1,000 balls down this quincunx, and at the end, they're all going to end up in these bins at the bottom, from down here to up here. All the balls are going to end up in here. What happens? This is what we get. Every ball is going to drop down the quincunx. It's going to hit this nail. It has a 50-50 chance of turning to the right or turning to the left. Then it hits this nail. It has a 50-50 chance of turning to the right or turning to the left. And then again and again and again. And eventually, every ball falls into one of these bins. Now, the chance of a ball every single time bouncing to the right is very small. The chance of it bouncing right and left an equal number of times is the highest. And what we end up with every single time we do this exercise, every time we put 1,000 balls down this chute, we're going to get this same result, which we can call a distribution. And very simply, most of the balls are going to fall into the center, fewer balls will make it to the next bins, and far fewer balls will make it out to the edges. Drawing a nice smooth curve over those distributions, we get what's called the normal distribution. And think of options trading, or think of trading the same way. When you buy Eurodollar today, as our example, we always tend to use Eurodollar as our example. When you buy Eurodollar today, there's a 50% chance it'll go up and a 50% chance it'll go down, but the market is already saying to us the current break-even equilibrium value is where we are right now. As many people think it's going up as think it's going down. So the most likely outcome is that we're going to stay right here. There's a small chance that we'll have a big move to the upside. There's a small chance we'll have a big move to the downside. But more than likely, we're more likely to stay near the current level than we are to end up way at the outside. Now let's suppose we have more nails, a longer shoot or a longer kinkunks. And more nails you can think of as more events or more time. Right? It's going to take longer to make it through 50 vertical nails than it is to go through 25 vertical nails. And you can think of every row of these nails as being another day. More time, what happens? We get a wider distribution. So with more time, of course, it makes sense. If you buy euro-dollar, the chance of it being 1% higher tomorrow is small. The chance of it being 1% higher in a year, of it reaching 1% higher in a year is much higher, because all kinds of events are happening and all kinds of things could move the market. So let's do a comparison of those two. The shorter time period or the less volatility event is that red line. Most of the observations are going to be in the center bins. And the blue, which is either more time or more volatility or a more volatile asset, we're going to see more results, more balls making it to the outer bins. And this is what the normal distribution looks like in statistics. Statistics is telling us, is using that same normal distribution. We have this measure called standard deviation. Standard deviation, which is it's just a mathematical measure of volatility. It's a measure of how volatile the market is. We can say that 68, if we drop all these balls down the kinkunks, we can say that 68% of our observations are going to be in these green buckets. 68% are going to be within one plus and minus one standard deviation of the mean. And what is standard deviation in options? It's the implied volatility of the option. Implied volatility is sigma. So to convert from sigma, from volatility to a standard deviation, you just take the price of the asset times volatility times the square root of time, where time is expressed in years. Don't get too bogged down in the math, but basically 68% of our observations are going to be between one plus and minus one standard deviation. We are 95% confident that that ball is going to be between one plus and minus two standard deviations, and we're 99.7% confident that they're going to be within three standard deviations. Or looking at it another way, suppose I have a strike. The market's trading right here today in the center, right at the mean. The market's trading right here today, and I buy an option with a strike out of the money here. So let's say we're trading today at 115 in euro-dollar, and I buy an option with a strike at, let's say it's 116, which happens to be one standard deviation higher than the current market level. If you add up these areas, if you add up the probability of being between 1 and 2 standard deviations and 2 and 3 standard deviations and higher, these add up to 13.6, and 2.1 is 15.7, 15.6. We have a 15.8. 15.8. There's a 15.8%, sorry, I have to draw with my mouse. I have to learn how to do this better. There's a 15.8% chance or expectation that the market's going to end up higher than that strike, higher than one standard deviation away. We can buy options with different strikes. We can buy an option with a strike that's at the money. In the examples that I gave earlier, the strike is 115. I can buy an option with a strike higher at 118. I can buy an option with a strike that's much lower, which is already in the money at 113, let's say. So an option that's far away is going to have a much smaller chance of finishing in the money. If the market's trading today at 115 and I don't get any payout until the market moves much higher, then I have a smaller chance of getting a payout. The delta is going to be much smaller. In fact, how much? The delta will be approximately, in this example, 15%. The probability equals roughly the delta. If the delta is 15%, that means there's about a 15% chance that that option is going to finish in the money according to the market. As long as we're talking about shorter dated options, not many years of options, and as long as we're talking about volatilities around the FX market, you can say that delta is approximately the same as volatility. Delta is approximately the same as the delta. Let's look at the value of an option. We had two distributions in the previous page when I showed you the two distributions, a higher volatility and a lower volatility, or more time and less time. On the top, this was the probability with a smaller distribution or a shorter option. If I buy an option, the market's trading, let's say we're doing some asset that's trading at 50, and I buy an option that's struck at 57. The area that you can see that's beyond the strike is very small. It's the shaded blue. So you take the shaded blue times the option payout is going to give you the value of the option. If volatility is higher, like we had in the second distribution, the same option is going to get much more action, much more payoff value, much more expectation of value. So the option is going to be more expensive. Higher volatility or a longer time gives you a more valuable option. And similarly, if the option was at the money, then I would have all of this area, 50% chance of this option finishing in the money. Therefore, it would be a much more valuable option. So we learned a few things. We learned that the closer to the strike we are for a call option, the more expensive it's going to be. So an out of the money option is cheaper than an at the money option. More time is more expensive and more volatility is more expensive. I'm not going to get into the why AVA options just yet. We'll come back to that later. I want to show you with pictures in the app, because the app really is your best friend here to help you learn about options. And I am, again, monitoring the questions. If people have questions they want to ask, I will interrupt myself and answer the questions. This is a picture, a screenshot from our app, from our mobile app. This is a screenshot of buying a call option. All we've done here is we've combined three elements on our screen. On the, this is a 1 week option. You see here it says 7 days. The expiration date at the top is 7 days. Our asset is Eurodollar. We're looking at a call option. On the left side of our screen, we're showing where has the market been for the last 7 days. So we've got a 1 week option. We're showing 1 week of history on the left side. So there's 1 week of history. Then we're showing in the white arc, we're showing 2 standard deviations of movement for 7 days. So we're showing where might the market be? What's a reasonable range to expect the market to be in at expiration 7 days from now? So we're framing the risk. And we're saying that there is a, what was our number? 95%? I always forget this, bear with me. There we go. A 95.4% chance, or 95% expectation that we're going to be within 2 standard deviations at expiration. So basically, we're pretty confident that the market's going to be somewhere on this page at expiration. Shaded in here a little bit more faded, you can see another arc. That's plus and minus 1 standard deviation. Okay. And then further out, you can see plus and minus 3 standard deviations. And then on the right side, I think I can erase all this. Yep. And then in the red and green, we're showing the profit and loss of the option. So this is just like the images that I showed you at the very beginning, but we've kind of turned it on its side. So this is a call option. We're saying if the market goes higher, you can have unlimited profits on the way up. If the market goes down, the most you can lose is what you paid for the option. And that's why you see in red, the most we can lose is $425. That's what we're paying for this option. But on the upside, we can have unlimited profits. In yellow, we're showing the value of the option today. So red and green is at expiration, and the numbers are at expiration. The yellow line is showing us today where we are. So just like I showed you on the other chart, you can see up here when we're deep in the money, the delta's close to 100% or 1.0. But down here, way out of the money, the delta's getting down towards 0. And here in the center, where we are right today, the delta is right around 50%. And in fact, you can see it in the description of this option. This is a call option. We're saying we're buying a 117.10 call. The price is 0.00425 times 100,000, which is $425. The delta is 0.5, and the volatility, the implied volatility, is 6.33. So you can see that the delta today is about 50%. The slope of this line, so the change in the option price relative to the change in the underlying, that's the slope, which is the delta, is going to be 50% for this option today. If I sell a call option, my delta is going to be negative. If I sell the option, I mean, the option itself, it still shows the delta is 0.6, but because I'm selling it, my delta is going to be negative. As the market goes higher, I'm going to lose money. I just want to show you how this app gives you a nice clear picture. When you're selling an option, you can have unlimited loss potential as the market goes higher. But if you're correct, if you sell a call and the market finishes unchanged or below your strike, you keep the premium, you earn the premium, which is, in this case, would be $488. Here's a put option. If I buy a put, I have unlimited profit potential as the market goes down. So my delta is negative. And you can see right here, it's a little hard to read actually, the delta is negative 0.51. Puts always have a negative delta, calls always have a positive delta. At expiration, our delta is close to -1. Today, we're at -0.5. And if the market is much higher, the delta approaches 0. What else can we see? I'm doing screenshots because it's hard for me to draw on the app when I'm sharing this from my phone. So I'm using these screenshots. Here's an out of the money option. So it's still 1 week. It's still a call option on Eurodollar, but now my strike is 118.20. So the market is trading at 117.06, but I have the right to buy at 118.20. It's out of the money. The market needs to get much higher before I start to get my payout. Because of that, the option is much cheaper. You see, the price of the option is $111. The at the money option was 400 something. So it costs much, much less because you don't get a payout until the market goes higher. It's a less risky proposition. Today, the delta of this option is equal to its delta, which is about 15%. You see here, delta equals 0.15. So the delta's 15%. The slope of the line at the money right here, this slope, or delta, is about 15%. Now, what else can we see that's very interesting about this? Notice that we've drawn the strike with this blue line. The strike is 118.20, and the delta is 0.15. You can see in the shading here that it pretty much matches, the 0.15 is matching the plus and minus 1 standard deviation area. So I've set the strike at 1 standard deviation higher than the current market price. And sure enough, we said that there's only a 15.6 or 15.8% probability of the market finishing higher than the strike. When we looked at the normal distribution, you can see it exactly here. I'm setting the strike at 1 standard deviation and my delta is 15%. So that's why I wanted to show you distribution and to make this connection between delta and probability. Okay. Someone is asking about a recording for the webinar. Somebody who joined a little bit late. Let me just say again, this recording, this webinar is being recorded, and we're going to upload it tomorrow to the Ava Options playlist of the AvaTrade YouTube channel. So you'll be able to watch this again. Here's an in the money call option. So this time I've set the strike in the money, which means I have the right to buy at 116, but we're already trading at 117. So it's already has value. It's in the money. It has what we call intrinsic value. Because if the market stays right here and finishes, the option has 106 pips or 107 pips of value. It's already in the money. So its delta is much higher than a half. In fact, today its delta is 0.85. And once again, I've set the strike at that -1 standard deviation area right here. And as we expect, the delta now is 0.85, because if we add up all of the area under the normal distribution curve from -1 standard deviation all the way to the end, to the right, to the upside, we get roughly 85% of the expected, or of the results. Or we really, the way we usually say it is that we can be 85% confident that we're going to finish above the strike. That's what the distribution says. Of course, everything is going to be random, but if you did this 1,000 times in random markets, everything would work out as we're describing, basically. Now I'm going to move on to strategies using the app, because not only can you trade the underlying instruments, like buying FX, buying the spot underlying instrument and selling the underlying, we can also buy and sell calls and puts, but we also can do combinations of options in the app. So we can do a call spread, for example, which is buying one call and selling another call. We have a guide embedded, or a guide integrated into the app. So for example, if you want to know what is a call spread, there's an explanation right there. And if you want to try it, you just click try it, or you can swipe through and see all the different strategies that we have to offer. Let's look at a strategy called a straddle. Straddle lets you buy a call and a put at the same strike at the same time for the same expiration date. So we're still on our 1 week option, but now we're going to buy a 117. I've set the strike at 117.07. I've got a 117.07 call and a 117.07 put. So the call is going to have a 50% delta positive. The put is going to have a 50% delta negative. So plus a half and minus a half, which adds up to 0. So the strategy, the straddle, has a delta today of 0. The slope of the line at the money is 0. However, as the market moves higher and higher, the call option moves in the money, the put option becomes worthless, and our delta moves towards 1. So that every 10 pips that spot moves higher, that euro dollar moves higher, the option value also will move higher, because the call will move higher, the put will be worth 0. Or if the market goes much lower, then our delta goes to 1 minus 1, because on the flip side, the call option becomes relatively worthless, but the put dominates, so our delta there will be minus 1. So combinations give you a net delta. And why is this important? Because we want to look at our entire portfolio. We have, both in the desktop platform and in the mobile app and in the upcoming web trader, we have a risk management window, which lets you look at the risk of all of your positions together. All of your calls, all of your puts, buying and selling the underlying. You might be long euro dollar and short euro sterling. You've got euro in both of those positions. Let's break it down. Let's take each position and break it down to its components. So for example, in this picture, this bar chart, we've taken all of our cable positions, we've broken them down. Let's say I'm long cable, long the pound against the dollar. It means I'm long the pound and I'm short the dollar. I'm long euros, I'm long gold, I'm long the FTSE, and I'm short dollars, yen, and CAD. Now this CAD position might be because I'm long Euro CAD. It might be because I'm short CAD Swiss. Well, I don't have Swiss positions, so I guess it's not from CAD Swiss, but you get the idea. We're breaking down the components to their individual pieces. And here's the numbers behind them for this particular account that I took a snapshot of. I don't know when this was, but this account was long a total delta of 1.38 million pound against the dollar, which was made up of 300,000 spot, or the underlying, owning the pound against the dollar. So I bought 300,000 sterling dollar. And I'm long a whole bunch of options, which have a net delta of 1.08 million. And it adds up to a total delta of 1.38 million. And so this isn't maybe a perfect example to show you, but I'll try to get into the app and show you more. We can break down and look at our delta per components by pieces so we know exactly what our exposure is, so that if we want to do some hedging, we know what to expect. How will our portfolio perform if the pound goes up or if the pound goes down? How much I expect our portfolio to perform as gold goes up or goes down if we have options on gold or options on silver. We also have a desktop Windows platform, which I'm not going to review too much, but it also has these same measures. It's a bit more old school, a lot of numbers, but you can see right in there, it's a little hard probably to see on your screens, but we show the delta of each option, more of in what's called an option chain or a full list of the options. So here are calls on Eurodollar, and as you buy an option that's in the money, like a 111 strike, that's got a delta of 68%. The at the money option from the day of this screenshot was 112.40, had a delta of 50%, and then as you move further out of the money, the delta drops. So we have this in both platforms. So now I'm going to attempt to switch my presentation to the phone so that I can show you the app and show you a little bit more about how options move while we have a little bit more time for our presentation. So let me just do this right now. And I am still watching if you ask questions. Somebody asked, Marcos asked, does the cost of trading this way take earnings? Well, if you sell options and your option finishes out of the money, you earn this income. But we're always valuing our options on a liquidation basis. If I buy a call, I have to pay cash for it, but sorry, 1 second. I pay for it, but it still has value. So it doesn't have any impact on my P&L on day one, but then as time goes by, the option is going to decay. The value of the option, the time value will disappear, and our delta gets to 0 or 1 or 0 and -1, and we have our intrinsic value, our expiration payoff. Let me get into the presentation here and say, bear with me 1 second. Sharing. Here we go, change presenter. Yes. Okay. I'm going to make myself the presenter. And I'm going to show you the app. This is the AvaOptions mobile app, which you've seen the screenshots for already. This is the main screen where I'm showing something that looks just like pretty much like any other trading platform. We've got the bid and the ask, the high, low, and close. You can add different securities. We've got equity indices here as well. We don't have options on them yet, but you can trade them as CFDs, just like an MT4 or MT5. If I scroll the right panel, I can see implied volatility information. And I can see where was implied volatility a month ago in red, where was it a week ago in green, and where is it now in blue. And this is showing us that for a 1 month options on Eurodollar, in the center, right here, you have what's called the delta neutral straddle vol. So this is the volatility for at the money options. And deep out of the money, an out of the money call, like a 10 delta call, has higher volatility, and an out of the money put has higher volatility. A month ago, that skew, that shape was a little bit more extreme. If we look at something like gold, you get much more skew, and volatilities are much higher. You can see the numbers behind that chart on the next panel. The next panel shows us information, chart recognition signals from AutoChartist. We have a presentation already uploaded about that. It's a great tool. And then some information like the lot size and pip value and leverage. But let's go into an option. I'm going to click Eurodollar. It takes us to our unique trading screen. We've got another 5 or 10 minutes to go. I haven't used this all day, so it's just updating a whole bunch of information. Now, this is a picture of where the market has been for the last hour. This is for trading spot, not for trading an option, just for trading spot. If I want to see more history, I can see where's the market been for the last day or the last week. I can swipe down here on the bottom and bring in more information. The candle size is showing up here. 12 hours, a 12-hour candle. I can also add indicators and stuff like that by clicking up at the top in that charting icon. So this is showing us the profit and loss from buying 100,000 euro dollar. Market goes up, we make money. Goes down, we lose money. It's symmetric, right? The red and the green. But let's go for an option. Let's look at a call. This is a 1-week call option. Let's make it longer. Let's go for a 6-month call option. So like I showed you before, we're seeing plus and minus 2 standard deviations with that white arc in the center. On the right side, we have a scale that shows us delta. If I put my strike up here, or the chance of getting up here is a 10 delta call. That means that at expiration, we think there's only a 10% chance of finishing higher than this level, which looks like 112.80 or something. And in the center, it's more like 50%. And then down at the bottom, you can see the delta is getting down to a 5% put. I can scroll around to see more information. So let's move the strike higher and higher and higher. There's a delta of about 13%. Here's a delta of about 20%. Deep in the money, the delta is 90%. Just like I showed you in the screenshots earlier. I can also long press on the strike and get a dialog where I can enter the strike in terms of delta or at the money forward, for those of you who are familiar with that. Or I can set my delta. Let's say I want to sell an option that has a 33 delta. This is a call with a 33 delta. I click apply, and there you can see it right there, 33 delta. The 33 delta strike is 120.40 for 6 months. So if I think the market's going to go higher, I want to buy that 33 delta, that's what it's going to cost, or more likely I might want to sell it. And I can get a good picture of what my expiration P&L is going to be. Let's look at buy again, because this is what I wanted to show on decay. Today we're on the orange line. At expiration, we'll be on the red or on the green. Watch this orange line as time goes by. It says here at the top, horizon now. The orange line is looking at our profit and loss now. We can move that orange line and say, well, what's my profit and loss look like after half of the time has gone past? What does it look like at expiration? Watch that yellow line as I move the horizon date from today to expiration. See, when you get to expiration, we're on the expiration line. We're on the red and the green. We match the red and the green. Today, we're on the yellow. And as time goes by, the option decays, the value drops, and we approach the expiration P&L. Let me show you a strategy where you can see it a little more clearly. Let's look at a call spread. In a call spread, I'm going to buy this call. Let's say I buy a, let's buy a 75 delta call, and I'm going to sell this 21 delta call. The net delta of these trades today, so right in the center at spot of that yellow line, the net delta is 0.75 for the one we bought and minus 0.21 because we sold one. So that's going to be a net delta of 0.54. So we got a 50% delta today in the center. But as time goes by, the delta is going to be approaching the expiration line. And because this is a call spread, if I'm between the strikes, my delta is going to be 1. If we're above the higher strike, my delta will be 0. And if I'm below the lower strike, our delta will be 0. See how that works? So you can see the delta, you can see how the option value changes over time. Let's do the straddle. I showed you an example of a straddle earlier. If I click horizon, over time, If the market doesn't move, you're just going to waste away all the money that you paid for that straddle. When you're buying a straddle, you want the market to move. If the market doesn't move, you end up right in the belly of your losses in the red. Okay. If I instead sell a straddle, I'm betting that the market, or I'm hoping or expecting that the market is going to finish unchanged or near the unchanged, and I can see where my break-evens are. I want to finish as close as I can to the current market level, which actually will be the forward level. Okay. Pretty neat, I think. You can play with this. You can have demo accounts. You can help use this to understand your risk. Now let's look at this account at my net exposures in the risk manager. I can see, for example, in the pound against the dollar, my total delta is minus 47,000. It's all from options. I'm short. It looks like my Vega is negative, so that means that I'm short an option. So I probably sold a call, or I've sold a put, I don't know. No, I've sold a call, so I'm short the market. So my cash position is 0, I have no cash, but my option position is short 47,000. We can find that option in our open positions. There it is right at the top. I sold a call in 100,000. You can see here that its current delta is minus 47,000 right there. If I click close, we can put it back into the same trading screen. And you can see, just like on the opening screen, the closing screen, you have that same functionality where you can see how the option performs over its life. And then you can close it, you can add a limit order, you can do things like that. This is a little, call it an Easter egg. If you long press on the profit and loss diagram, you can make it a little bit smaller or a little bit larger for those who want to see it bigger or smaller. Okay. Now, suppose I want to hedge this. This is saying that if the market goes up, I'm going to lose a whole bunch of money. My net exposure is just as if I'm short 47,000 of spot. So if I want to hedge that, look at the risk manager. If I want to hedge that, I should buy 47,000 of spot. I'm short 47,000. So let's say we go ahead and buy 50,000 of cable. So I'm going to go here to the pound. I'm going to buy 50,000 spot. Click, execute. It's done. Sweet and fast. I go here to my open positions. You can see it at the top. So you can see I'm long 50,000 from spot, and I'm short almost 50,000 from the option. And in the risk manager, there it is. My net delta is almost 0 because I'm long 50,000 spot, I'm short from options. So now what I effectively have is I've hedged my risk and I've converted it into an exposure that's similar to a straddle, which is me talking fast, but that's because we're pretty much out of time. So let me ask if you have any questions while I have the app up here. And I'll just show this again. Strategy guide, what's a strangle? What does selling a strangle look like? I can swipe. What's a seagull? All these different strategies. What's a call ratio backspread? If you want to impress your friends. Put ratio backspread. You think that looks interesting and you want to try it, you click try it, and it opens that strategy in the trading screen, and you get something wacky that looks like that. I can change my expiration date at the top to 3 months, still have the same strategy, and as I move my strikes, everything updates. And then as I change the horizon date, you can see how the option evolves over time. I mentioned earlier we're building a web trader, which is which will let you have an interface just like this one in the web, just in any browser on your desktop, and we hope we'll have it out very soon. Kuldip is asking about demo accounts. All you have to do is download the app, install the app on your phone, and you click to have a demo account, or you go to the AvaTrade website and sign up for an Ava Options demo account. You have to go to the Ava Options page on the website. And from the Ava Options page on the website, if you sign up for an options account, you can get a demo. If you go from that page, you can get a demo account. But you have to make sure you're on the options page when you do that. And if you have an account already, someone is mentioning you already have an account, just log into the AvaTrade website and click to add an account. When you add an account, choose an Ava Options account. Add demo, and then choose Ava Options. If you have any trouble adding an account, you can either use the mobile app and just click free demo, or you can log into the AvaTrade website and add a demo or open a demo. And if you have trouble, reach out to your account representative. Okay, we're out of time, folks. Any last questions? As I said, we are going to post this on YouTube, on the Ava Options YouTube channel. We have lots of videos there, and you can also see the same videos in the app. If you click this top left menu, which lets you do things like deposit and withdraw and do all these things to your account and upload your documents, if you click videos, you can watch these videos right on your phone, because we all wander around the earth staring at our phones. You can watch these videos in your phones, including webinars like Why Trade with Options, examples of the features, Ava Options, why, what, and how. And tomorrow you'll find what is delta and why is it important. I'm being asked about option leverage. Options are instruments that are by nature, by definition, leveraged. However, in terms of margin, when you buy an option, you don't need any margin. If the only thing you're doing is buying options, you just need cash to pay for the options. If you're using leverage, options are explicitly excluded from ESMA leverage limits in the EU. So we offer 100 times leverage when you're trading with options. So if you trade an option on the pound or an option on Eurodollar, you're going to get 100 times leverage. But if you trade options, if you trade spot on the platform, then you're limited to ESMA limits, which I believe is 33 to 1. Fester is asking about placing a trade using AvaTrade Go. Using AvaTrade Go, you do have an options-like product called AvaProtect. AvaProtect is more of an insurance product where when you open an underlying position, let's say you buy Eurodollar, you can buy an hour of protection. And you can buy or 2 hours or 6 hours of protection, which is essentially buying a put. But it is not trading options like I'm showing you in this app. You need to open an Ava Options account. You don't need any more documentation. Once you have an account in AvaTrade Go or MT4 or MT5, you already are covered and you can open up an options account, transfer funds into it and trade away. Okay, somebody is saying that he has 400 to 1 leverage. 400 to 1 leverage is for customers outside of the EU or who are opening accounts anyway outside of the EU. That's available through AvaTrade Go or MT5. With options, if you're buying options, you have unlimited leverage. And if you're going to use leverage, you're limited to 100 to 1. We don't offer 400 to 1. That's it. I think we're going to run out of time. No, my screen just died. There we go. I'm going to have to end the webinar now. Thank you, everyone, for joining me. Please do use this app. I really think it's helpful to play around, to understand. It's fun to use. Give us some feedback. Give it a nice review in the Play Store if you can, because that's nice for me to see. And have a great trading week. Thank you.